Welcome to the debate from GiltEdge.uk. Before we begin, this content is for informational purposes only and does not constitute financial advice. Always do your own research and consider seeking independent financial advice before making any investment decisions. Your capital is at risk. Today, The Guardian and The Challenger go head-to-head on lock in your mortgage rate now. Fixed deals are your insurance against a world on fire. Let's get into it.
2-year fixed rates have jumped from 4.83% to 5.35% in just 3 weeks. Swap rates have spiked nearly a full percentage point since late February. If you're sitting on a tracker right now, you're gambling that this stops here, and I wouldn't take that bet.
You're telling people to panic buy a fixed rate that's already priced in the worst-case scenario. A tracker at base rate plus 0.75% is 4.5% right now. That's £124 a month cheaper than a 5-year fix at 5.39%. That's real money.
It's real money until the base rate goes up. The Bank of England just held at 3.75% but explicitly said it stands ready to raise if inflation persists. 1 hike and your tracker advantage shrinks. 2 hikes and it's gone.
But the base rate maths doesn't support 3 hikes. The UK economy is barely growing, GDP was flat last quarter. The MPC isn't going to hike into a stagnating economy just because swap markets are having a panic attack.
Tell that to the people who said the same thing in autumn 2022. The trust comparison is instructive. Swap rates spiked, lenders pulled products overnight, and people who waited found themselves facing rates 2 percentage points higher than what they could have locked in.
That's exactly my point though. The trust spike reversed within months. Markets overshoot. Every single time. If you'd panicked and fixed at 6.5% in October 2022, you'd have been kicking yourself by spring 2023.
Sure, but you'd also have had certainty for 2 or 5 years. You wouldn't have spent every MPC meeting refreshing the BBC wondering if your mortgage payment was about to jump.
Certainty has a price. And right now that price is nearly a full percentage point. On a £250,000 mortgage, fixing at 5.39% instead of tracking at 4.5% costs you almost £1,500 a year. That's the insurance premium you're asking people to pay.
And insurance is exactly what it is. You don't complain about your home insurance premium in the years your house doesn't burn down. The question is whether you can absorb the risk if rates do spike, and most households can't.
Most trackers have caps, and you can switch to a fix at any point if things genuinely deteriorate. You're not locked into a tracker forever. But once you fix, you're locked in. Early repayment charges mean you can't take advantage if rates fall.
That optionality argument sounds great in theory. In practice, by the time it's obvious you should have fixed, the best deals are already gone. Lenders pulled over 400 products in a single week during the last spike.
And they put them back a few weeks later, usually at better rates. The market corrects. It always corrects.
Eventually, yes. But can you afford 6 months of elevated payments while you wait for the correction? The numbers have flipped, the gap between trackers and fixes has narrowed dramatically, and the risk-reward just doesn't favor floating anymore.
The gap hasn't narrowed, it's widened. That's the whole problem with fixing right now. Fixed rates have surged because of swap market volatility, not because the actual base rate has moved. You'd be locking in fear, not fundamentals.
Swap rates reflect where the market thinks rates are heading. You're essentially saying you know better than the entire derivatives market.
I'm saying the derivatives market has a well-documented tendency to overprice risk during periods of uncertainty. Swap rates priced in 6 Bank of England hikes after the mini-budget. We got one. Markets are pricing mechanisms, not crystal balls.
Fair enough, but here's the thing, even if you're right that markets are overshooting, the downside of fixing is you pay a bit more for stability. The downside of tracking is potentially hundreds of pounds more per month if you're wrong.
It's not a bit more though, is it? It's £124 a month from day one, guaranteed. You're paying a premium today against a risk that may never materialize.
Let me put it differently. If someone is choosing between a 2-year fix and a tracker, and they can't comfortably absorb a £200 monthly increase, they should fix. Full stop. Budgeting certainty isn't a luxury, it's a necessity for most families.
On that, we actually agree. If your budget has no slack, fix. But that's not everyone. For borrowers with savings buffers and financial flexibility, a tracker is the rational choice right now. The expected cost is lower and you keep your options open.
So your advice comes with a means test, trackers for the comfortable, fixes for everyone else?
Every mortgage decision should come with a means test. That's just responsible advice. Blanket fix now before it's too late. Headlines help lenders shift expensive products, not borrowers.
I'd rather someone paid £124 a month more and slept soundly than save that money and lay awake every time tariff headlines hit the news.
And I'd rather people made decisions based on the actual numbers rather than anxiety. The base rate is 3.75%. Fixed rates are 5.39%. That spread is telling you something. It's telling you the fear premium is enormous right now.
We're in a world where trade wars are escalating, inflation is proving sticky, and the Bank of England is openly discussing rate rises. This is not the time to bet on the best case. Lock in, protect your household, and revisit in 2 years when the dust settles.
The dust always settles. And when it does, tracker borrowers will have saved thousands while fixed-rate borrowers will be counting down the months until they can remortgage at something more sensible. Don't let fear set your mortgage rate, let the fundamentals do it.
The Guardian, The Challenger, thank you both. What do you think? Let us know in the comments. Read both articles in full at gilt-edge.uk. Thanks for listening to the debate.